Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 315th VideoCast podcast for the week ending October 29th, 2025. We got a lot to cover today, but as always, family first. Some great photos from a Halloween party at our friend David's house. Absolute incredible time. That's me with Mimi and Annabelle. There's Annabelle throwing, there's Mimi throwing axes. There's Caitlin and I in front of the shark. Caitlin with the girls, me with the girls, the whole crew. Absolutely fun time. Thanks to David. This is with my buddies, Daryl and Tony, and new friend Steven. Played Mesa Verde earlier this week. Some more of the crew and the three most beautiful girls in the whole wide world. Now, on to some media. Want to thank Peyton Jennings for having me on with Stu Varney on Fox Business. We're going to listen in here.
As you can see, we got a rally up 240 points now on the Dow Industrials, but the NASDAQ, that's where the action is. I keep saying this. The NASDAQ's up 327 points. Thomas Hayes joins us this morning to cover this market rally. Is this rally today, is this mostly about China?
Well, Stu, I do think so. Our China holdings, Alibaba's up about 3% overnight. Baidu's up 5% overnight. People are very positive. This has a lot of impact. This successful framework, as Besson put it, the preliminary consensus, as the Chinese put it. So the market likes this quite a bit.
Big tech rally. Big tech, I should say. They're going to report later on this week. And today, all of those big tech stocks are moving up. Does that suggest we're going to get good results from big tech this week?
This is the moment of truth, Stu. We've been a little bit skeptical here. We're going to find out, is this rally durable into year end, or do we need a breather before the year end rally? The first two Mag 7 were underwhelming, with Netflix and Tesla talking about margin compression. Does the market keep paying over 30 times earnings for the Mag 7, despite their earnings growth having halved year on year? We're going to find that out on Wednesday and Thursday. There's over $400 billion of CAPEX committed this year. So far, the return on investment has been de minimis. So we want to see that forward guidance. If the forward guidance is great, this market will keep pushing higher. If there's a little bit of uncertainty, we may get a little pullback, 3, 6, 7%, and then rally into year end. So we're going to find out by Wednesday or Thursday.
And you'd buy any dip for a year-end rally. Got it. All right, Tom. Out of time. Sorry. Come back and see us real soon. Tom Hayes, everyone. Thank you.
Thank you.
Let's get to the mayoral.
And we're back. And then I had the pleasure to join David Lynn on the David Lynn Report. He always has the most engaged audiences. You want to listen in here for the full overview of how I'm thinking about things right now. You couldn't give Intel away at $19. Now everyone wants it at $39. And I think it's going to make the taxpayer a tremendous amount of money over the next 5 years. While everyone looks at Tesla trading at 13 times revenues and 200 times earnings, the only way you don't make money is if you buy low quality stuff that has balance sheet risk. If you buy the high quality stuff when the weighting is this low in the index, you tend to make enormous amounts of money. You can still get.
I'm pleased to welcome back Thomas Hayes. He's the managing member of Great Hill Capital and also the author of Hedge Fund Tips. Check it out. Very good resource online for all investors. We'll be talking about the Fed. What are they going to do this week? We'll do a preview. We'll talk about a potential China deal. Stocks are up today on Monday on a potential. And of course, earnings season is upon us. Welcome back to the show, Thomas. Good to see you.
Thanks for having me, David.
I want to start with this potential China deal. Actually, it's driving markets higher. Gold is down 3% on the day. Stocks are up, and Bitcoin is up today. So risk on day. New records on stocks on Monday after China and the U.S. officials cooled tensions over the weekend, according to reports. Now, no official deal has been ironed out as far as I'm reading. But I think there's a framework that's being discussed. I think we have a very successful framework for the leaders to discuss on Thursday, said Treasury Secretary Scott Bessent. This is days away from November 1st, which is the day that Trump initially said would be the start date for new 100% tariffs on China. So I guess we're not seeing that anymore, Thomas?
Yeah, look, you have, as you said, Besson said, we have a successful framework. The Chinese counterpart said we have a preliminary consensus. We saw some of our Chinese holdings were up huge overnight. Babo's up 3% and change. The Baidu's of the world were up 5%. So the market is saying this looks money good. We will find out for sure on Thursday. You never know. With President Trump's negotiations, sometimes at the last minute he'll throw a curveball to get a little bit more for the American people. But on balance, that looks very good. That's constructive. That's why you see tech up big today. But I think we got a lot more to focus on earnings this week. That's going to be the real tell.
Yeah, we'll get to earnings and discuss that in just a bit. But this confirms, I guess, partly confirms the theory that every time a new tariff is announced, that's just a buying opportunity. Do you buy that?
Until it's not. But yeah, I mean, look, as you know, we've been excessively bullish when other people were bearish. And that's now going back, multiple years to the fall of 2022. We did get a little cautious this month. We built up a little bit of cash. We have no margin. And we'll see if that proves to be correct. And if we get a buying opportunity before the final year-end rally, or if this just keeps pushing higher. But a lot of this has been retail driven. You're seeing it in option flow. You're seeing it in triple and 5X leveraged ETFs and all the craziness that's coming with that. But I think when all is said and done, David, price is what you pay, value is what you get. And I think this is the moment of truth this week. And we're going to dissect some of that in the imminent earnings in coming days.
So what are the key drivers of multiples expansion now going into 2026 now?
Well, usually you get multiple expansion when you get growth expansion. And this time is different, so to speak, so far. What we're going to see, as we saw with Netflix and Tesla, the first two kind of Mag 7 Plus that reported, was some concerns about margin compression. And you saw Netflix down pretty big off of that. Tesla was a little bit uncertain off of that. And if we look year on year, David, Mag 7 earnings growth is decelerating from 32% in Q3 of 2024 to what's expected to be 14% in Q3 of 2025. So a halving of earnings growth, and yet the multiple for the Mag 7 basket has stayed well above 30 times. It's usually the opposite. When you see earnings growth decelerate, you see multiple compression, not multiple maintenance or multiple expansion. So, Mag 7, $400 billion of committed CAPEX this year, which is a 67% increase from last year. And so far, very little evidence of return on invested capital, which is why you're seeing earnings growth contract. That's going to impact margins. That, as you saw with Tesla and Netflix, that's going to impact buyback ability, which impacts EPS. So will the market continue to assign a very high growth multiple to a group that is decelerating in earnings growth at present? And the answer is we're going to find out on Wednesday and Thursday.
Right now, there seems to be a trend that the tech companies are spending a lot on CAPEX. In fact, it's considerably higher margin on CAPEX than the other S&P 500s companies. And so, Thomas, the question is whether or not this trend has actually been pushing up the entire stock market. And as soon as maybe they stop spending money for whatever reason, that's when we get a slowdown.
Well, there is something to be said for that. It's interesting. The stock S&P is up around 41% off the April 7th trough. 27% of the Russell 3000 is only up 10% or less since the April 7th trough, which tells you we've basically been in the camp that maybe the Mag 7 needs to stall for a bit on the basis of earnings growth deceleration and high multiples. However, it doesn't mean everything has to do poorly. Maybe the answer is an abrupt shift into those stocks that have been left for dead, that are not the AI cost centers like the Mag 7, but the AI beneficiaries that benefit from the technology and have margin expansion without massive amounts of investment like you're seeing across the Mag 7. So we could see that type of shift. And then you look, we're in the final week of October, David. This is the end of tax loss selling for mutual funds. And oftentimes the stocks that have done worst year to date going into the end of October tend to do extremely well in November once that tax loss selling pressure is in the rear view mirror.
And so now with AI in full swing on everyone's radar, what are some sectors or plays that investors can take? Are we looking at hyperscalers, construction companies around that are involved with data centers? Are we looking at the big Mag 7 companies themselves, or anything on the periphery? How are you doing this?
We've always looked to find the derivative plays. So one of the holdings that we've had that has been tremendously unpopular was Alibaba. You couldn't give it away a year, 2 years ago. It just kind of was left for dead. China was uninvestable. It turned out it was the cheapest AI play in the world. When everyone was saying it was uninvestable at $60 a share, now people are getting interested at $175 a share. They had $80 billion of cash on the balance sheet at that point. They were generating $25 billion of free cash flow. You couldn't give it away. So that was an easy one. That's just getting started. Alibaba is going to continue to press higher. So while everyone looks at Tesla trading at 13 times revenues and 200 times earnings, you can still get Alibaba at a low double-digit multiple with a huge blue skies ahead. The second way we played that was Intel. No, you couldn't give Intel away at $19. Now everyone wants it at $39. Intel was easy peasy. When the government stepped in to backstop that, the game became the US government decided we are not going to depend on Taiwan Semiconductor for all the semiconductors in the world. We are going to stand up Intel. And they're the only game in town in the US that was at the 10-yard line. Gelsinger had actually put everything in place. It's just the board got antsy, even though they authorized him to do everything, because the stock price was down. So they got rid of Gelsinger. They brought in someone that even better, Lip Bhutan from Cadence Systems. He had a 68 plus bagger there. He did a huge turnaround at Cadence Design Systems, and he's going to do the exact same thing in Intel. So they got two tailwinds. One is advanced chip development at their fabs, GPUs, and their legacy CPU business has started to recover aggressively. So that's already up double plus from the lows, and I think it could double again over the next few years as the advanced chip demand becomes basically unlimited. And Taiwan Semiconductor, NVIDIA's biggest problem in terms of growth rate has not been for lack of demand. It's been for lack of supply, because Taiwan Semiconductors capped them at $4 billion of revenue growth per quarter. With Intel getting into the advanced chip game, that was a huge, easy way to play that AI play. And then finally was Comstock Resources, which is a natural gas play. If you consider the data center demand for the next handful of years going into 2020, 2030, you look at some of the Goldman Sachs numbers, triple digit increase, 60% of that is going to be powered by natural gas. And sometime back, you couldn't give these stocks away. Comstock Resources is 75% owned by Jerry Jones. We built up a position, $8, $9, $10. That's just getting started. It's one of the lowest cost producers of natural gas, and that's going to be an AI beneficiary as well. So we're looking for the non-obvious ways, the ones that most of the juice has not been squeezed out of the lemon, where there's a lot of runway ahead. And I don't see it as aggressively in the Mag 7. When you think about some of the names that I've mentioned, with Baba almost tripling off the lows, we think that can double again. Intel doubling off the lows, we think that could double or triple from here. Comstock Resources double off the lows, we think that can double again. I don't think you can say that about too many of the Mag 7 stocks that you expect them to double over the next few years, or could double or triple. I think that would be pretty aggressive relative to a decelerating growth rate and a monstrous amount of CAPEX required, and a big prayer session that they're actually going to get a sufficient return on invested capital prospectively.
And are you banking on energy companies being acquired by the tech companies? Microsoft, for example, is restarting a nuclear facility. Potentially, they could go further into the vertical integration. What do you think?
It's not out of the question. I don't think that's their highest and best use of the capital, but I wouldn't rule it out. That's not in our thesis. The name of the game is the demand is going to be there. And I think these energy companies know that. So why would they want to sell out at historic low multiples? Speaking of energy, by the way, in that basket of 27% of the Russell, that's only rebounded 10% off the April 7th lows while the market's up 41%. You got energy, you have real estate, and you have consumer staples, the ones that have been left for dead that I think you're going to see a bid. So as it relates to energy, the sector as a whole is at its lowest weighting in the S&P 500 since when? Since COVID 2020 lows. We made an absolute fortune buying Exxon at $33 and change when oil was trading negative. We are in a position right now with some, and I'm less sanguine, believe it or not, on the E&P oil companies than I am on some of the servicers, but we're in a position with the weighting so low. If you buy energy when they're this far out of favor, it's really, really hard not to make money. The only way you don't make money is if you buy low quality stuff that has balance sheet risk. If you buy the high quality stuff when the weighting is this low in the index, you tend to make enormous amounts of money. The last time prior to COVID that the weighting got in similar low single digits was 2001, which was the last tech mania where you couldn't give away an energy stock. And then the next 5 to 7 years, what outperformed? Energy did, value did, international did, small caps did. And I think we could see a similar situation, not that tech has to crash, but in terms of relative performance, where's your opportunity? And you just chase the things that are already up a lot, or do you look for things that can double and triple over 3, 4, 5 years?
Going back to Intel and tech stocks overall, how do you feel about the government making equity stakes or making investments into companies themselves? Earlier in the summer, Intel announced that the Trump administration is placing an $8.9 billion investment into the company to make an agreement, and they'll help expand the company. How do you feel as an investor with the companies getting involved with the government?
Well, I think people complicate the Intel deal. The problem with the Intel deal was the previous administration said, we're going to give you $9 billion because you're pathetic and we think we need you at some point. Trump comes in, he goes, wait, we're giving them $8 billion for what? For failing? No, we're giving you $8 billion. We want something in return. This is not your money, Intel. This is the taxpayers' money. Like they work, 4 or 5 months of the year to pay the US government taxes. They're going to get something in return. So not only are we going to stand you up, but we're going to give them equity. And then just like President Trump, commander in chief, goes out and sells planes for Boeing, even though we have no equity stake in Boeing, he's going to go out. If you think he can sell planes for Boeing, wait till you see how many chips he sells for Intel. And you saw it the next week, NVIDIA was asking Trump for favors to be able to sell some of their chips in China. Guess what? They miraculously put a $5 billion investment in Intel. And then SoftBank, Masayoshi-san, put in a $2 billion investment in Intel. So this is, in terms of Trump demanding that U.S. taxpayers get paid for capital that was already committed, he is being a responsible steward of our tax dollars. As it relates to these mineral right deals, I'm less sanguine on that in terms of I don't want to see unlimited government interference because, there was some rumors earlier like, oh, look how much how many contracts we're giving to these defense companies like Lockheed. We should have equity in Lockheed. I think that becomes a slippery slope, and that's problematic. I think Intel was different. He walked into capital that had already been committed with no strings attached, and he said, no. If you want the taxpayers' money, the taxpayer is going to get something for it. And as it relates to the rest of them, the mineral rights, I think that's to be determined. We certainly need these specialized resources. And to the extent that the private market can't sort it on its own, could there be different deals done where the public sector comes to bear for national security reasons? Yes, hopefully we can avoid those at all costs. But if absolutely necessary, I think it is something that needs to be done for national security.
The stock's up roughly 60% since the deal was announced late August. I think as an investor, you're looking at this trend and saying to yourself, well, one or two things could happen. Either the government continues this trend. There were rumors that Trump wanted to make investments into some quantum computing companies. That has been refuted by the Department of Commerce. But anyway, if they do continue this trend, we could continue to see stocks being pumped up, but potentially the government may misallocate company resources into things that some investors in those companies may not deem productive. So it's a double-edged sword. What's the future here? What do you think?
I think that the company's board of directors in each respective deal has the opportunity to say no. And what that simply means is we don't want your money and we don't want your strings. But if they say we want your money, they should expect to have the strings attached to it. And that's, there is some free market element. It's no different than any other outside investor that says, we're going to give you money for equity or for debt. We want this voting right, or we have this say, or we want these terms, or we're not going to give you the money. And now the company can say, keep your money. We'll get it elsewhere with the terms that we want. Or they'll say, we can't get it elsewhere. Therefore, we will submit to whatever terms you deem appropriate. And I think it's no different with the rare earths. I think it's no different. I mean, as far as the quantum computing stocks, that seemed like a little bit of silly season and a little bit worrisome. Fortunately, that's not showing that that there's going to be any follow through on that. But to the extent that it becomes a national security. Look, you've got DARPA working on similar things. So maybe there'll be more and more public-private partnerships in the name of national security. But when it comes to investing money in a company and or taking equity or debt, the company companies will have the right to say no or demand different terms, and I think that's just the case. Now, if the administration starts co-opting companies, we haven't seen any evidence of that. That would be a different situation, and I think there would be a huge uprising against that type of behavior. We haven't seen it to date. And in terms of Intel, it's proven to be a success. And I think it's going to make the taxpayer a tremendous amount of money over the next 5 years. It's going to be one of the best investments taxpayer money has ever been involved in.
And if restrictions are placed on tech companies for exporting to China, for example, NVIDIA, those restrictions were in place by Trump. But anyway, if they double down, the current administration doubles down, is that a sell-off kind of impetus for you?
Look, I think I was against the restrictions that came to bear by the previous administration. I mean, the previous administration's stance was China bad in every way, under every circumstance. Let's not talk. Trump is China's fine as long as they give us what we want. And if we can come to a deal where we make more money than we lose, then we love China. And if we can't, we'll isolate them and go back to the China bad for every possible reason under the sun, like the previous administration. Trump is willing to talk. Trump is willing to do a deal as long as Trump, aka America, gets paid and benefits from it. As far as refusing to export chips to China in the name of national security, I think it was the worst national security mistake we've seen in many, many years. And the reason is because China used to be dependent on us, and they used to take what we would give them and they would take it with open arms, and they would just funnel money into our coffers and create massive earnings power for the US companies. Now we've said, we're not going to allow you to give us unlimited amounts of money because we're not going to give you our chips in the name of national security. And what China has done is they have gone on to make incredible chips on their own. And on that basis, they've gone from being dependent to now being independent to now being in some areas superior. If you look at some of their large language models like Qwen with Alibaba, like some of the chips that they're developing internally, we kind of let the genie out of the bottle. They would have not been that far ahead on innovation had we continued to supply them and continued to keep them dependent on our technology. Now they're becoming independent and in some areas excelling beyond us.
Okay, let's move on to the Fed. It's Fed week this week. Importantly, Besant has named top picks to replace Jerome Powell. Fed chair finalists are Christopher Waller, Kevin Warsh, Kevin Hassett, Michelle Baumann, Rick Reeder. We have a short list now, and no one's been confirmed yet, but it looks like everyone is, correct me if I'm wrong, but it seems like everybody is supportive of much lower rates. Is that correct?
I think everyone except for one is supportive of lower rates. I think Warsh has a history of being hawkish, and he's playing the game that he's going to be cooperative in order to be given a serious consideration. I think it's not dissimilar to what we saw from Powell before he was confirmed, that he seemed flexible. And then the moment he came in, if you remember the autopilot comment in December of 2018, where he basically crashed the market before Christmas, and Mnuchin had to come in and convene a meeting of all the banks 3 days before Christmas on a Sunday to create liquidity and pump the market back up. I think that Waller for sure, Bowman, all of these are good. Warsh, Reeder, they're all fantastic picks. I think Warsh, you really run the risk of once he's in doing whatever the hell he wants. And I'm not saying he's not competent. He's very skilled. He would be the wild card that I would be very concerned about in terms of maybe keeping things too restrictive, too long, thinking he knows better, and maybe putting governors on the economy that don't necessarily need to be there in the short term. So I think 4 out of 5 are phenomenal. Everyone I talk to loves Warsh, so maybe I'm missing something. But if you go back to his stances over decade plus, he's often been very, very hawkish, and now he's kind of changed stripes in order to be in the mix.
I love looking at betting markets on issues. Who will Trump announce as Fed chair in 2025? No announcement by December is the majority of votes. And if you actually look at who people are voting or betting on, rather, Hassett is slightly leading Christopher Waller. I mean, it's pretty close when it comes to these. The first two, rather, are pretty close. Yeah. So anyway, if you had to put your money on and bet, nobody knows, but who would you bet on?
I think any of those would be great. I think Hassett or Warsh, and maybe Bowman. President Trump does like to appoint women to positions. He's been one of the most pro-women, pro-diversity kind of administrations historically. Never gets any credit for that. It wouldn't shock me if he put in Bowman, but I certainly think Waller, Warsh, all of those would be good choices. As far as whether he makes the announcements before December, that's going to be dependent on what Powell does. If Powell cuts this week and he cuts in December, Trump is going to let him ride out like Seinfeld on top, and let him have a kind of victory lap and let him go out with style. If he tries to choke things up by either not moving this week, which I think is unlikely, or not moving in December, I think at that point Trump will announce his, top 1 or top 2 picks and make it clear to the market that that Powell is a lame duck until he vacates his seat in 2026. But hopefully it'll be a cooperative policy, a pro-growth policy from the Fed, and Powell can go out and have a favorable legacy.
So we're looking at least a 25 basis point cut this week, Thomas. So last time you were on the show, you mentioned to me that once unemployment ticks up, it's a very hard genie to put back in the bottle, I believe, were your words. And now we have 4.3%. Let me just double check. Yeah, 4.3% as of
Well, we have no idea. We have no data. So
that's right. That's
oh, and by
2
the
months
way,
ago.
there is that thing called the we've got 27 days into a shutdown. Economists estimate 10 to 25 basis points a week for every week of the shutdown. Yes, it's earned back once it reopens, but no one's paying attention to it. I think the longer this thing drags on, if you get that coupled with mixed guidance with the Mag 7, I think you could find ourselves maybe with a little bit of pullback. Ordinarily, when you have these 15% plus mid-year corrections like we had in April, and then you hit all-time highs, there's a secondary correction in that year that averages 6.4%. We haven't seen it yet. Is it coming as a result of maybe some surprises this week? I don't know. But any of those dips, if they did materialize, are to be bought, because year to date, we've got 312 going on 313 central bank cuts this year globally around the world, which is the highest since the post-Great Financial Crisis in 2009. So there's a lot of liquidity sloshing around in the system, even if we get some short-term shocks, whether it's from the shutdown, whether it's from Mag 7 earnings, or something else geopolitical or otherwise. As I said, we've been, accused of being a perma bull, and that's been right. We raised some cash this month. We're, have zero margin effectively. And we've been waiting for a pullback that may never come, which is fine. There's also something to be said for locking in a huge year, but we'd love to see some type of volatility that we could benefit from, and then play into the year-end rally. So we'll see how that materializes.
Well, how significant is the government shutdown on Fed policy decision making? Because on the one hand, like you said, we don't have official unemployment data from the BLS, but we have other private data that's tracking payrolls. But on the other hand, we did get CPI released last week, and so could the Fed just ignore unemployment for now and look at a higher CPI print and maybe slow down their dovishness? Is that possible?
I think it's a low probability that they don't move this week, but as is the case with the Mag 7, the key is going to be the forward guidance. So yes. I think if they're not going to be immensely penalized for more hawkish than normal guidance if they cut. And so what's the downside for them doing it? And I don't know that the market expects them to do it. So on that basis, I would say maybe that there's a surprise in that. They cut 25 basis points and then they come out hawkish at the 2:30 meeting saying, we don't have data, inflation came in better than expected, but it's still more elevated than we would like to see, or above target, or some type of language like that the market maybe interprets as December off the table for the next few days, and until they start to get employment numbers and realize, no, December's well on the table. The labor market's a little bit weaker. I think, the sooner we get that employment data, the clearer we're going to know the trajectory moving forward. But the trajectory moving forward is lower rates, whether there's a pit stop in December or not. Trump has made it abundantly clear that the next Fed chair will be dovish. And so if we pause for a couple of months until Powell vacates, then so be it. But I think everything is pointing toward lower and lower rates for the foreseeable future.
I want to close off, Thomas, on alternative assets. You and I haven't spoken much about the precious metals, but it's become more of a mainstream topic in the last couple weeks to months. Major banks, JP Morgan and Goldman Sachs, are upping their gold forecast by the end of 2026. I believe Goldman has a $4,900 outlook by the end of 2026. This is the price so far. The gold price has pulled back from its highs. This is kind of mirroring what happened in 2011. Anyway, do you have a view on this asset? Do you have an allocation to it? Have you allocated more on this really historical rally? It's up more than, let me just get the exact number here. To the peak, it's up more than 60% year to date.
Okay. So, what's interesting about gold is that it's a non-productive asset. So when people say, "Oh my gosh, gold is the greatest thing that's ever," look, it's up 61%. Do you know how many stocks are up, over 60% this year? Like, while everyone was focused on gold, the amount of stocks that you could have bought in the April trough that are up double and triple already is unlimited relative to gold. So spending your time on an asset that you're buying in hopes that people will come behind you and push it higher based on demand for fear or geopolitical or debasement trade. Look, if you get debasement, it's like Warren Buffett said, whether we get paid in dollars or seashells or shekels or whatever, if you're buying a business that provides value to the marketplace, you're going to command the most of those seashells, shekels, gold coins. It's really immaterial. The key is buy a productive asset. And if there's a debasement trade, you'll just get more shekels per value provided, and find great companies when they're temporarily impaired. And doubles and triples over a 3 to 5 year period are relatively easy to find if you have a solid framework. As far as gold, you're effectively guessing. I think the theme is correct that the dollar is going to trend weaker over time, in which case gold, in theory, should remain elevated. But why play that game when there's so many other opportunities where you actually have some level of control over analyzing the forward cash flows and what you'd be willing to pay for those forward cash flows versus just hoping there are other buyers coming in behind you. So to those who have allocation and have been gold bugs for the last 20 years and now have their day in the sun, congratulations. This is the day you've been waiting for. Like they say, the most expensive drink in the casino is the free drink because it means you're still at the table. So take a few chips off the table, take your free drink, maybe let a few chips ride if that's your game. But beware, because the clock strikes 12 and we'll see if Cinderella does okay.
A couple of years ago, Berkshire Hathaway did own Barrick Gold for a few months, I believe, until they sold it off. And the play there, and Warren Buffett has never liked gold as a bullion, mainly for the reasons that you talked about. But he did buy a miner. Would you consider a miner if the free cash flow is extraordinarily strong at current gold prices? I'm not saying they will be, but if. Yeah, no, I found that the miners, no matter how high the price of the underlying asset goes, they somehow figure out a way to lose money. Like invariably, maybe they get a quarter or two where they generate free cash and everyone says, "Oh, this time is different." But somehow that mining business is a really difficult business. I don't think that was Warren himself. I think that was his Ted. And you see these tiny little positions come and go, kind of trading. There's never been a Warren Buffett. There never will. We're seeing that. And I could almost guarantee that wasn't Warren's decision. Okay, fair enough. Thank you very much, Thomas. We'll end it here. And please do follow Hedge Fund Tips. Very good resource, good summary of the news, as well as other information and analysis and charts. Thomas, where else can we follow you?
Yeah, hedgefundtips.com is the best place. Then you could subscribe to our weekly podcast. There, it's stock market focused, individual companies, ask me anything, questions from the audience. That's probably the number one way. And it's also anywhere you get your podcast, Hedge Fund Tips with Tom Hayes, and the YouTube channel. If you go to YouTube, just type in Hedge Fund Tips and all of our stuff is there. Okay, excellent. Thank you very much, Thomas. Thank you. We'll see you again next time. Appreciate it, David. Great. Thank you for watching. Don't forget to like, subscribe, follow Thomas, and follow this channel. And we're back. And then update, I will be appearing at the Ritz-Carlton Sarasota on December 1st and 2nd for the Money Show. I've got 3 different segments I'm going to be in on the 1st and 2nd, 2 on Monday, and a breakout room on Tuesday. So definitely click there to get your registration. And give me a heads up if you're coming so we can set time to meet and say hello and maybe grab a coffee or lunch or dinner if you're a client and in the area or potential client in the area. That's going to be a fun time. This is a quote from Buffett: "Beware the investment activity that produces applause. The great moves are usually greeted by yawns." Absolutely. Then we've got Jesse Livermore: "The stock market is never obvious. It is designed to fool most of the people most of the time." And then finally, want to thank, got a few new pictures in. Again, ton of orders. Really grateful for the community coming together and being supportive. And as I always say, the greatest compliment you can pay is just, if you're getting value and making money, share it with one person you care about that likes stock markets or investing, etc. And we've gotten a lot of great referrals. There's Nick Saltarelli from Midday Squares. You can get his stuff at Whole Foods and other fine stores with his hat on. And then here are the boys from England. Patty Knapman, absolutely love this photo on the golf course, and a bunch more. So go through those. Get your hat, get your t-shirt, get your polo. We're getting into winter. The hoodies are amazing. Get your mug. And when people ask, tell them, spread the good news, tell them about it, pay it forward. And we keep growing the way we're growing. We're going to keep doing this for a long, long time for clients and non-clients alike. Super, super grateful there. If you have merch, which I'd say 20x more people have merch than we have photos, go ahead and send your photos into info@hedgefundtips.com. We'll get you on the website. And while you're there, click on terms. This is all opinion, not advice. Okay, let's get to some data. We got a lot of it to cover this week. Russell 2000 index relative to the S&P. Russell is, this is trailing EPS relative to trailing EPS. The key chart you want to look at is forward EPS with Russell this quarter at 42% earnings growth, small caps versus S&P. By the way, estimates were very close. People keep talking about the beat rate. We usually beat by 3%. So far, that is not the case. It was around 8% estimates. We're at 9%. So we're seeing some of it today with Meta is down 8% after hours. So Mag 7 has been less than. Google was good. Microsoft's down, Tesla was down, Netflix was down big. So as expected, let's see if we get a little break in the indices here, because we've had that cash ready to go. And I think in the next few days and few weeks, we're going to be deploying all of it and getting back on a little bit of margin as well. Nothing crazy. We never go over 10, 15%, but I think we're going to be able to deploy a lot of cash in coming days and weeks. So we're super excited because we got a little volatility in early October after we got cautious, but we really, the market's just been kind of grinding, and so much retail option flow. And I told you that there is no way in hell those retail options are getting paid out. The 20 million contract, 40 million contract a day of call options for 20 consecutive sessions, those are going to expire worthless, and we are going to benefit from some weakness here to get the remaining cash and excess margin availability to work before end of year, and we're super duper excited about it. Crowded short interest sometimes creates huge rallies. Yes, that is correct. And what he's speaking to is, what is Brent crude oil spot prices? 52 increase, decrease, managed money, short open interest. You can see they're super short at the lows in May 2017, super short at the lows in June of 2020, and super short right now. And I think we're going to start to see a lot of opportunity in oil. We've expressed through National Oil, Varco, and Comstock, which, by the way, there was a full feature article on the Wall Street Journal this afternoon, which we'll touch on. Next, largest stocks have underperformed over the last century by about 0.8% per year. Periodically. Periodically, the largest stocks outperform in the last century. This has happened 5 years or more 7 times, 10 years or more 3 times, 15 years or more 1 time. The current outperformance is the second longest in the century at 10.5 years. So you can see This is an extreme. It never ends well. You want to be more diversified. And if you're in the S&P saying you're diversified, you're not. You're basically in a Mag 7 index, which, as we're seeing here with Meta and Netflix and all these, the spending's up, the margins are contracting, and the multiple hasn't come down. That's going to change. And I think we're seeing the early stages of that right now. So, U.S. equity leadership cycles and peaks, U.S. versus developed markets. That is now rolling over. USA versus emerging markets now rolling over. You can see these past peaks, and then you get periods of the opposite, where emerging markets start to outperform relative to U.S. and international relative. We're seeing it this year. Median forward returns and win ratios after high beta 5-day decline to 10%. So this implies 7,300. I agree with 7,300. I just think it's a next year phenomenon, not a this year phenomenon. Gold, obviously everyone bought the top, so now they're going to get punished. Top 10 U.S. companies dominate U.S. world equity market. Country GDP, market cap index, we know all this. 10 strongest buyers markets of September 2025. So the switch has flipped. In a lot of the hottest markets are now cooling and becoming buyers markets versus sellers markets. That was the opposite 2 years ago. Just the beginning. The affordability is going to happen. Everyone who said house prices are going to go up because rates go down are going to be wrong this time. What you're going to see is supply go through the roof and overwhelm demand. Chart of the day, shutdown drags on. This is whistling past the graveyard. We're almost 30 days into the shutdown. That's somewhere between 40 to 100 basis points off of GDP. It'll be earned back if they stop it soon, but there is a point of no return where it has negative detrimental effect, which I think could exacerbate the expected volatility in coming days and weeks. We shall see. Bankruptcy filings are falling as spreads tighten. That's a positive thing to see. And then, so credit spreads are still tightening. That'll be good for Cooper Standard to refinance their debt. Emerging market stock index, third highest level in 37-year history. Looks like it's going to break out. There's usually no such thing as a triple top. So this cycle that everyone said would never happen a couple years ago, pounding the table, is now happening in spades. Next is S&P 500 post-election cycle versus 2025. That's for this year, implies some short-term volatility. Next year also should have some chop, which benefits stock picking because the indices slow down. Wage growth is outpacing home price inflation finally, and that's positive. Vans is enjoying strong momentum. Proportion of arrivals on US and UK retailers' websites selling out in a majority of sizes July 1st through October 15th. Vans Old School, 200% change from last year. Vans Authentic, that's better than Nike Cortez, Adidas Samba, and Adidas Superstar. Number of global rate cuts in the past 24 months, almost at post-Great Financial Crisis highs. It is now at, because 312 turned to 313 today, which means we have the most amount of Fed cuts globally since August of 2010. That's massive liquidity. And that's why I say if we do see 4 to 8% pullback here, it's to be bought. 121-day streak above the 50-day moving average is actually third longest streak since 2007. The 2011 streak ended 130 days. Either way, indeed, both streaks would end with at least 20% declines. 2011 intraday thereafter. We look for excess in markets, always mean reverts. So this is Seth Golden talking about a correction. I like this stuff that he's putting out here. I don't think it's going to be anywhere in that neighborhood of 20%. I think that's recency bias, but I do see, 4 to 9%. I think we could see, which would surprise a lot of people. Call yourself, this is from Lou Bassanese, good friend. Call yourself a contrarian, then you should be loading up on oil. Amen, brother. Couldn't agree with you more. Nothing hated more than that right now. Data center loads expected to double by 2035. 60% of that's going to be fueled by natural gas. When the top 10 concentration is greater than 23%, the bottom 490 equal weight has outperformed 88% of the time over the next 5 years. Let me repeat that. Probably the most important chart of the week. When the top 10 concentration is greater than 23%, the bottom 490 equal weight has outperformed 88% of the time over the next 5 years. Shelter disinflation is happening and likely more to come. Amen. Hallelujah. Markets now predict 5 more cuts by 2026, followed by gradual rate hikes from 2028. That might have changed today. Carson cycle composite for the S&P 500. Again, this is not following. People are trying to say it's following exactly. We had a huge correction in April. I do think we're going to get end of year follow through. I think we're going to see some short-term chop between the Fed. Let's see what happens with Trump and China and Mag 7. People are waking up to the fact that the return on invested capital is not coming anytime in the near term, and they've been paying for it. And I think that's why you see things like Netflix fall 10%, and you see Meta fall 8% after hours. You see Microsoft down, etc. At this point in Trump's first term, energy was down 9%. It's down 5% now. Tech was up. It's up now. So it's all kind of tracking. S&P was up 13%. So we could almost, a lot of these things are in line. Probably staples have to play catch up. Financials have to catch down. Healthcare has to catch up. Materials has to catch up huge. And that's kind of in line with what we're seeing, where we're seeing opportunity. Materials for sure has to catch up. Healthcare and consumer discretionary. Okay. Companies are not talking about negative macro catalysts. Okay. Gross leverage. Net leverage. Gross leverage is pretty high. PE ratio exposures. S&P 1500 PE ratio exposures. You got 25% of the S&P 1500 has a multiple of greater than 50 times. That's insane. %7 has multiples between 10 to 15 times. That's an interesting distribution. S&P 500 growth index divided by S&P 500 value. It's at the top of the trend line here, rolling back over, just like you saw in 2000, and you had a massive value outperformance. So again, just for the newer people, the themes that we see playing out in the next 5 years: small caps over large caps, equal weight over cap weight, international versus domestic, which is playing out huge this year, but we were saying it last year before it happened. I think healthcare is going to start to outperform. I think energy is going to start to outperform. Materials, defensives. So pay attention to that. Margin expansion is in the red zone, super high. I think we get a little bit of that knocked out here in the short term. CAPEX share of operating cash flow for hyperscalers is now 60%. That's what's weighing on margins without yet showing the return. Market's starting to get impatient, justifiably so. Here are the incentives available. This is from Car Dealership Guy. A lot of 0% for 60 and 72 months now. This is what we said. Incentives are the leading indicator of volumes. Volumes is what the name of the game for Cooper Standard, which has been a machine. Global AI investment and spending. That's showing up in the earnings. Quarterly EPS estimates. Okay, I don't really worry quarter to quarter. I look at annual. McClellan summation rolling over while the indices are holding up. There tends to catch down. S&P 500 returns are worse when analysts are most bullish, and they're talking about the Magnificent Seven and the tech bubble. Long-term earnings growth rates. Consumer confidence in the stock market. This tends to be bullish once it bottoms out. So these are the countervailing forces. So sentiment is washed out. That tends to be generally bullish for the market over coming years. We generally agree. We're generally constructive. We just think short term, there are going to be more opportunities. You shouldn't be buying up. You should be buying down. I can't remember the times we bought stocks on a green day. So as we've had green days, we've been sitting on our hands and waiting. And I think the time is coming imminently. U.S. public sector infrastructure spending was weak for a decade, suggesting scope for catch up. Positive sales surprises going up. That's good to see. Estimated financing breakdown for must be all those circular deals. I'll vendor finance you. You buy my stuff. You buy my stuff. I'll vendor finance you more. Total CAPEX, overbought, oversold composite. Definitely showing overbought here. Margins typically peak more than a year ahead of equities. Number of quarters from peak margins to S&P peak. On average, margins peak 9 months before the S&P peaks. So that's kind of interesting. We'll see what happens to margins this quarter, then extrapolate out 9 months. What else do we see here? Number of quarters from peak margins to recession is on average 11 months. Skeptical we're going to see a recession in 12 months, but we'll keep an eye on it. 10-year Treasury constant maturity minus Fed funds rate. That's kind of interesting. Fed funds is less important than 2s10s inversion. The 2s10s inversion typically precedes a recession by 6 to 9 months. So that would be something else. I could see a mini recession late next year. I mean, that would be an incredible opportunity. But I could definitely see a situation where that doesn't happen as well. So you get over this line, though, you tend to start to run a higher risk. And that's just a function of Powell being too restrictive for too long. Another clue to expect a strong year-end rally. So that's Dietrich giving more bullish stats for end of year. Staples plus discretionary washed out. So everyone's betting against the consumer. It's a huge opportunity there. Rewarded so far. CAPEX, still early, but higher CAPEX has been rewarded so far. I think that changes this quarter. We're seeing it after hours. Evolution of Q3 consensus earnings. So yeah, Citadel Securities retail option volume. Okay, what did you see right before the April crash? Elevated retail. This is double the elevated retail we saw before the April crash of this year. Double, if not, yeah, double. So if you think these guys are getting paid, you are not in your right mind. Retail percent of total cash market. Again, last peak was Jan 2021. Fed balance sheet unwind could end as early as October. It's now going to end in December. Plenty more easing ahead in the pipeline. We agree. That's why we remain constructive intermediate term, even though we're cautious short term. Like cattle starting to roll over. That could start to help restaurant stocks. So keep an eye on this. This was a big move this week we've been waiting for. 30-year fixed mortgages. Are we going to get below 6 before the end of the year? When I said it in the beginning of the year, everyone said, crazy town. I said we were going to get a high 5 handle, 5.9, something like that. We're 13 bips away. Let's go, baby. 8 weeks to go. Number of 20% drawdowns in the S&P 500 in the last 7 and 10 years. Rolling 10 years. Rolling 7 years. So like I said, there's been a lot of pull forward. If it averages every 3.5 years, we've had a lot, which is why I don't think we're getting another 20% anytime soon. I'm in the 4 to 9% camp, and we'll go from there. Let's see here. We got quality factor. What do we have here? Consumer confidence survey, current jobs availability, jobs plentiful. So that peaked in 2003, has been trending downward since. Jobs hard to find is starting to trend upward. Keeping an eye on that. ETF flows since September 24th rate cut. Starting to see a little bit into healthcare, a little bit into energy, a lot into industrials, tech, financials, same thing. Levered long AUM, relative inverse AUM is at a peak. Levered long, these 3 and 5 times, these are going to get a flushing. How much of the S&P is related to AI stocks? So again, it shows the concentration and so on. Okay, let's get to some headlines. Trump expects to sign China trade deal at Xi summit. If correct, that will be very, very good for Alibaba. Future Fed cuts far from certain after divided meeting. Powell injects new doubt by highlighting growing cores of officials who are worried about further reductions. So leave it to Powell to throw a wrench in the spoke of your kid's scooter. Meta shares fall on accelerating AI spending despite record revenue. Company warns of aggressive capital expenditure growth, sending shares down more than 8%. This is Metaverse spend part 2, in which case he will relent, but only after the market punishes him beyond belief. Moving along, Jerry Jones says he has unlocked a $100 billion gas bounty in this drilling inferno. Cowboys owner backs Comstock's bid to develop some of the hottest, deepest wells in the United States. We are co-investors. He's at 7. We're between $8 and $9 a share, and just getting started. So super excited about Comstock. You can read this at the Wall Street Journal. Next, foreign investors show renewed interest in China equities. HSBC report says China streamlines foreign investor rules to lure long-term funds. Next, China vows to significantly boost household consumption rate. Who is the toll taker? Alibaba, 40% of e-commerce. E-commerce much bigger in China as a percentage of economy than the US. So think Amazon on steroids. China urged to weigh 2008-style mega stimulus by ex-PBOC advisor. What do you think that'll do for energy like it did in 2009? Oh, and if you remember, who put the floor in the market in 2009 in energy was the Chinese, bought every barrel they could get their hands on. Alibaba is coming for Meta's smart glasses and ChatGPT. The stock rises. China blows past record for Europe car sales on hybrids, EVs. Lithium prices boosted by China's policy drive on energy storage. Go Albemarle. U.S. stocks are breaking records. The rest of the world is doing better. You can see MSCI All Country World ex-USA is outperforming by almost double. Boeing posts Q3 revenue beat, improving cash flow burn rate as CEO Ortberg's turnaround plan takes off. The best Boeing salesman is at work in Asia. The stock is up. That is Donald Trump. Not if you think he can sell planes, wait till you see what he does with Intel chips once they're ready to go. Etsy names new CEO, sending shares down despite profit beat. So they beat. They had great results. Market's uncertain about the new CEO who ran Depop, which is their fastest growing business. So I think after the short term shock, she's Stanford, Harvard MBA. The stock will start to recover. It'll probably be dead money for the next few weeks, then start to recover, and we'll see when it gets to full valuation what we want to do, but we're not near that yet. VF Corp tops Q2 forecast on strong back-to-school wholesale demand. So that was good to see. We'll go into that in excessive detail next week, but every single sector was performing. Every single group performed better than expected. We're comfortable with that. Our Vans cooler than Sambas now, so you can see the stats here. Skate shoes are going crazy. Vans is number one in skate shoes. Just the beginning. PayPal signs deal with OpenAI to become the first payments wallet in ChatGPT. How you doing? PayPal joins with Built to use Venmo for rent and mortgage payments. Intel CEO says he joined to refocus chip giant on AI and foundry. Albemarle to divest Ketgen control Eurocat stake in deals worth $660 million. U.S. natural gas sector deals surge in 2025 on AI LNG demand from Asia. Mortgage rates dropped to the lowest rate in over a year, pushing refinancing 111% higher annually. This is early days, ladies and gentlemen. Profit margins aren't just higher in tech, called a Moneyball rally. We'll see how that shakes out in coming weeks. Generac cuts full-year sales forecast on weak residential demand for generators. They had a weak hurricane season, not enough bad hurricanes. Their data center demand backlog is monstrous. Nothing to see here. Hang tight. If it goes a lot lower, we'll buy more, but it would have to go an awfully lot lower because our basis is so low. Hormel cuts forecast on price pressure, consumer backdrop, parts waves CFO. We're going to cover that one in detail next week. No change there. They now expect sales for the fourth quarter will be toward the top end of its earlier guidance, between $3.15 billion and $3.25 billion. So their earnings will be a little light, but their revenues keep growing. They'll get the bottom line fixed at these prices, and with those brands, the margin of safety is significant. We'll go into specific detail next week. Meta shares dropped 9% despite earnings beat as company takes a one-time tax charge and also guides on CAPEX spending. Fed cut rates again, but Powell raises doubt about easing at next meeting, and so on. Fed cuts. Okay, we got that. Here are the 5 key takeaways from the Fed meeting and Powell news conference. Delivered its quarter percentage point. Strong language, pushed back hard on another cut in December. Leave it to Powell. End of quantitative tightening coming towards December. Powell said inflation remains elevated, drifting back towards target, and gave a nod towards the uncertainty of the shutdown. Microsoft takes $3.1 billion hit from OpenAI investment. And article of the week is Old Dog's New Trick Stock Market and Sentiment Results. Each week, we try to cover 1 to 2 companies we've discussed in previous podcast, videocasts, and or own for clients, including personally. When Uncle Sam becomes your business partner, this is on Intel. Good things tend to happen. That's exactly what we saw in Intel's first report, with Washington riding shotgun. Revenue came in at $13.65 billion, up 6% sequentially and 3% year over year, beating street estimates of $3.15 billion and topping management's prior guidance by about $600 million. Earnings per share of 23 cents came in well ahead of consensus at 0.01, and management guidance for break-even results. Altogether, the quarter marked Intel's fourth consecutive beat on guidance and its first profit after 6 straight losses, the company's longest losing streak in 35 years. This was a stock you couldn't give away at $18 or $19 a share, with investors blinded by the uninvestable label and looking at me like I had 2 heads for pitching the name. Fast forward to today, and Intel now sits second only to AMD as the best performing AI name year to date, outperforming every Mag 7 stock that investors continue to clamor for. Now that the stock has more than doubled from the lows, analysts have been forced to take price targets from $20 a share to $40 a share overnight, and suddenly everyone is interested. This wasn't on anyone's bingo card except for the loyal listeners of Hedge Fund Tips with Tom Hayes. That's because when viewers tune in each week, they do what we like to call burdening ourselves with the facts. That means taking the time to actually look under the hood and do the fundamental work on a company-by-company basis to know what we own. When you do that, the Intel thesis becomes simple common sense, about as straightforward as they come. The US government had no choice but to step in and backstop Intel. Without Intel, the entire world would have its eggs in the TSMC basket. Washington couldn't let the future of advanced chip making rest in the hands of a single foreign company, and Intel was the only firm on US soil standing on the 10-yard line of achieving that goal. But it's not just Uncle Sam that can't afford for Intel to struggle. Every major chip designer, from NVIDIA to AMD to Mag 7 names, currently depends on the kindness of strangers for advanced foundry work. And there's only one stranger in town, TSMC. No company in its right mind wants to rely on a single supplier halfway across the world. Jensen Huang didn't write a $5 billion check out of the kindness of his heart. He did it because his growth is capped at $4 billion a quarter at TSMC. The knight in shining armor to fix this is now Intel, and for that reason, there is nobody in the world that wants Intel to succeed more than NVIDIA. Now that Intel has the world's best salesman on its payroll, aka Donald Trump, it won't be long before major clients start lining up for its foundry business, between $5 billion from NVIDIA, $2 billion from SoftBank, and rumors of more partnership ahead, talks with around an Apple investment, early discussions with AMD as a foundry customer, and a potential Microsoft deal. The pipeline is heating up fast, and if you think President Trump can sell Boeing planes, just wait till you see how many chips he can sell. In the end, we wouldn't be surprised if the $9 billion stake in the U.S. taxpayer now holds in Intel goes down as the single greatest return on investment in taxpayer history. Keep in mind, while the headlines around Intel focus on the foundry business and AI, our investment case from day one has always viewed those as whipped cream and cherries on top. We underwrote the investment with 3 potential outcomes. Number 1, Intel gets broken up or liquidated tomorrow, book value worth $22 a share, we'd come out whole. 2, Intel survives as a leader in mediocre chips, maintaining its legacy CPU and server business worth about $45 to $50 a share. Or 3, Intel executes on its foundry business and AI vision worth $100 plus per share. In any of these scenarios, it's heads we win, tails we win less, but still win. This all comes down to one simple principle and what Warren Buffett calls the 3 most important words in investing: margin of safety. When you know what you own and you don't let headlines shake you out, investing in great companies becomes a waiting game. And as long as humans remain emotional and impatient, there will always be plenty more time arbitrage opportunities just like Intel. Here's the breakdown. We highlighted the important parts. You can read it at hedgefundtips.com. And 10 key points. Number 1, Intel made significant progress cleaning up the balance sheet, securing nearly $20 billion in cash through deals and improving its net debt position by roughly $15 billion sequentially. During the quarter, the company achieved $5.7 billion and $8.9 billion total U.S. government funding, $2 billion from the SoftBank's investment, $5.2 billion from the sale of Altera, and its Mobileye stake, $900 million, with $5 billion NVIDIA investment expected to close in Q4. Management used part of these proceeds to repay $4.3 billion in debt and plans to continue prioritizing deleveraging through 2026. Intel also returned to positive free cash flow, generating $900 million of adjusted free cash flow during the quarter. Whose bingo card was that on? None other than Hedge Fund Tips with Tom Hayes. 2, Client Compute Group. All right, that surprised me a little bit. Revenue for the quarter, it happened faster than expected, was $8.5 billion, up 8% sequentially and 5% year over year. The growth was driven by the ongoing refresh cycle, Windows 11 adoption, and rising demand for AI PCs. With Panther Lake's first SKU still on track to launch by year-end and additional SKUs planned for the first half of 2026, along with Arrow Lake ramping and Nova Lake strengthening the product lineup, management believes they now have the strongest PC portfolio in years. Looking ahead, management expects client consumption TAM to approach 290 million units in 2025, marking two consecutive years of growth off the post-COVID bottom in 2023, the fastest TAM growth since 2021, and setting the stage for another year of healthy PC demand. 3, data center and AI group. DCAI reported revenue of $4.1 billion, up 5% sequentially, ahead of expectations due to stronger enterprise demand and growing AI workloads that are driving both refresh activity and capacity expansion. Management believes the underinvestment in traditional infrastructure over the past few years should allow server CPU revenue TAM to grow comfortably going forward. Most importantly, they noted that current demand continues to exceed supply capabilities across both the client and data center AI business, a dynamic they expect to persist well into 2026. 4, Intel's deal with NVIDIA will integrate Intel's CPUs alongside NVIDIA's AI graphics processors, which currently account for about 90% of the AI chip market. Management expects the partnership to create multiple years of engagement between the two companies, aka GPUs may be in the cards down the road, and to open up a new market opportunity for Intel, expanding its TAM in a way that is incremental rather than cannibalistic to its existing business. 5, Foundry revenue came in at $4.2 billion, ahead of expectations and driven by increased wafer output. The segment reported an operating loss of $2.3 billion, representing a 54.8% operating margin, which narrowed materially compared to the same period last year when Intel Foundry posted a $5.8 billion loss. Management's confidence and conviction in the Foundry business continues to grow, with projections calling for a greater than 10x increase in gigawatts of AI capacity by 2030, creating significant opportunities for Intel Foundry with external customers. 4, yields and performance on 18A continue to make steady progress, with management noting that yields are on track to reach internal milestones and have improved at a predictable rate. The 18A node is expected to drive wafer volumes well into the next decade and deliver healthy returns on investment. Management believes that by the end of 2026, 18A yields will reach a level appropriate for margins, and by the end of 2027 will be considered industry acceptable. During the quarter, Intel also opened Fab 52 in Arizona, its 5th high-volume fabrication facility, which is now fully operational. 7, management's confidence around 14A continues to grow, supported by encouraging engagement with external customers and positive early feedback. Yields on 14A are off to a strong start, showing significantly better performance at this stage of maturity compared to where 18A yields stood at the same point. Intel plans to remain disciplined in adding capacity, investing only when external customer demand is confirmed. Management noted they are heavily engaged in these discussions and are beginning to attract key process technology talent that can help drive long-term success. 8, adjusted gross margins came in at 40% for the quarter, up 22 percentage points year over year from just 18% and 4 points above management's prior guidance. Hallelujah. The improvement was driven by higher revenue and a more favorable product mix, partially offset by the early ramp for 18A and Lunar Lake. 9, management remains disciplined on reining in operating expenses down to just $4.54 billion compared to $11.05 billion during the same period last year. Operating margins for the quarter stood at 11.2%, up 22 percentage points year on year. Intel remains on track to right-size the company by year-end, target of 75,000 employees, with a current employee headcount of 88,000, down from 124,000 during the same period last year. And 10, for Q4 guidance, management expects revenue of $12.8 billion to $13.8 billion, which is roughly flat quarter over quarter when accounting for the Altera transaction, and in line with Wall Street consensus of $13.4 billion. Management expects non-GAAP EPS of 8 cents, down 5 cents year over year, and gross margins of approximately 36.5%, down sequentially due to product mix and impact of initial shipments of Core Ultra 3. Here are the key comments from Lip Bhutan. You can read at hedgefundtips.com. And finally, we move on to PayPal updates. As it turns out, old dogs can learn new tricks. When Alex Chriss took over the reins at the granddaddy of fintech a little over 2 years ago, he inherited a company that had fallen asleep at the wheel after riding the e-commerce boom during the pandemic. Prior management had stopped innovating and tried to make up for it by spending billions on acquisitions that struggled to integrate. Growth was slowing, transaction margins were under pressure, and the user base was declining. From day one, Alex Chriss, who we knew was a winner based on what he accomplished leading the small business group at Intuit, has been laser focused on getting PayPal PayPal back to what made it great in the first place, innovation. While his shock the world comment that many laughed at may have been a bit early, he has delivered on everything he said he would and more. Transaction margin dollar growth is back on pace for 6 to 7% this year. Free cash flow is on track for a record $6 to $7 billion. Margins have inflected. Venmo has accelerated. Unprofitable PSP customers were fired, and active accounts are growing again. On top of fixing what he inherited, Alex Chriss has also positioned PayPal back at the forefront of innovation, leading into and launching products like buy now, pay later, stablecoins, agentic commerce, Fastlane, PayPal World ads, and omnichannel. In his own words, they have, quote, moved this business from defense to offense, all part of the goal of transforming PayPal from an online payments company into a commerce company. For those who know what they own and actually understand the business, none of this innovation should be surprising. The market, however, spent the last 2 years distracted by the slowing growth narrative and ignored everything else. The reality is that this was a deliberate shift away from the empty calorie growth at all cost strategy that was popular under prior leadership. That shift created a temporary 5 to 6% drag on the top line, which fed the market's mistaken narrative. Now that we are lapping that drag and PSP is back to profitable mid-single digit growth and accelerating, the market is finally beginning to pay attention to the innovation that has been right in front of it all along. The flurry of deals we have seen recently is case in point. First came the agentic commerce deal with Perplexity back in May. A few weeks ago, it was a multi-year digital commerce deal with Google that cements PayPal as a key PSP across payment service provider across Google products. Earlier this week, they partnered with MasterCard to advance secure agentic commerce, and on the same day integrated Venmo across the entire built ecosystem to allow users to pay rent or mortgages through Venmo. The list goes on. Then came the whipped cream and cherries on the top. Right before earnings, PayPal announced a deal with OpenAI to become the first payments wallets integrated directly into ChatGPT. We already knew Alex Chriss and Sam Altman had a relationship going back to Altman's WorldCoin days, which we flagged on this podcast weeks ago. So this partnership was something we had a feeling might come together at some point. All of this ties back to our broader AI beneficiary investment thesis that we have discussed in recent podcasts and articles. Rather than owning the companies forced to pick up the AI tab and erode earnings in the process, we prefer to own the beneficiaries of AI in the unmagnificent 493, trading at much lower multiples with accelerating earnings, and let the hyperscalers pick up the tab. We get a free ride on their coattails, capturing all the upside without spending a dime. Going back to PayPal, the point is simple. This company is back in growth mode. We've highlighted the key points from the ChatGPT article and from the earnings breakdown and put stars next to the super important points and the deck and the earnings call transcript, I believe. Let's see. Yes. So here are the 10 key points. Number one, PayPal reported net revenue of $8.4 billion for the quarter, up 7% year on year, beating Wall Street consensus by approximately $182 million. Non-GAAP EPS also came in well ahead of expectations, rising 12% year over year to 1.34 and beating consensus by 13 cents. Number two, during the quarter, management returned $1.5 billion to shareholders through the repurchase of 21 million shares of common stock at an average price of $71. So for all those whiny little bitches that were saying PayPal, and didn't know what they owned because they're worried about the price versus the value of the stock, guess who you were selling to? Not only me, but you were also selling to Alex Chriss with the company buying back your shares and taking you out of your stock. On a trailing 12-month basis, this brings the total repurchase to $5.7 billion or 78 million shares, reducing the weighted average share count by 6%. In addition to buybacks, PayPal announced the initiation of a quarterly dividend, declaring a dividend of 14 cents per share and targeting a 10% payout ratio of non-GAAP net income going forward. Most importantly, this new dividend does not impact the company's share repurchase program and is intended to complement it, with management maintaining its long-term framework of returning 70 to 80% of free cash flow to shareholders, the vast majority through buybacks, and targeting $6 billion in repurchases for the full year. 3, adjusted free cash flow for the quarter was $2.3 billion, up 48%. Let me say that again. Free cash flow was $2.3 billion for the quarter, up 48% year over year. This reminds me of PayPal. This reminds me of Alibaba at $60 when you couldn't give it away and they were generating over $20 billion of free cash flow per year. And you can't make this stuff up. Bringing the year-to-date free cash flow to $4.3 billion. Management reiterated full-year free cash flow guidance of $6 to $7 billion, which would mark a record high and imply 11% free cash flow yield at the midpoint. 4. The payment service provider segment has now turned the corner after lapping the, quote, firing of unprofitable customers, with total payment volume up 6% year over year and accelerating from 2% growth in the prior quarter. This includes enterprise payments Braintree, which delivered mid-single-digit total payment volume growth and is now consistently contributing to transaction margin dollar growth. Management plans to expand PSP segment into physical retail during Q4 through the Verifone partnership. 5, Buy Now, Pay Later continues to perform well, and management plans to lean into it even further in coming years. Buy Now, Pay Later is expected to reach $40 billion in total payment volume for the full year, growing to more than 20% year over year, and outpacing the broader market, which economics on par with or better than peers. Management continues to see Buy Now, Pay Later drive a meaningful uplift in overall user activity and engagement, similar to what is observed with Venmo and PayPal debit cards. 6 times the transaction frequency and 3 times average revenue per account. They view Buy Now, Pay Later as a generational shift in consumer behavior that PayPal is well positioned to lead. Looking ahead, PayPal will expand BNPL into new geographies and product offerings in 2026, having launched in Canada last week and set to extend its reach across Europe. 6, Venmo's total payment volume, TPV, increased 14% year on year, accelerating from 12% last quarter and marking the 4th straight quarter of double-digit growth. Full-year revenue is on track to reach $1.7 billion, up 20%. Venmo's revenue is up 20% year on year and 10 percentage points above 2023's growth rate. Management believes Venmo is still in the early innings of monetization driven by Pay with Venmo. Monthly activities up 25% and the Venmo debit card monthly activity up 40% and over 1 million first-time users added in Q3 through college partnerships. For the 66 million monthly active accounts, ARPA is greater than $25 and growing mid-teens, with management seeing massive room for monetization as ARPA remains 1/3 to 1/4 of peers, $75 to $100. If ARPA reaches peer levels and the MAA base remains flat, currently plus 7% year over year, Venmo could generate $4.95 to $6.6 billion in annual revenue over time. Venmo is just scratching the surface. 7, branded experience, which include PayPal, Buy Now, Pay Later, Venmo, and debit card programs, saw total payment volume grow 8% year on year, led by the U.S. with 10% growth, more than double last year's rate. Growth was largely driven by omni-channel initiatives such as debit and Tap to Pay, which delivered 65% total payment volume growth and continue to scale globally. Branded checkout TPV still grew 5% during the quarter despite a choppy macro environment. While PayPal saw less pressure from Asia-based marketplaces selling into the U.S., this was partially offset by softer consumer discretionary spending in the U.S., in Europe, and the U.S. later in the quarter. 8, management once again raised its full-year guidance following a hike last quarter, lifting non-GAAP EPS guidance to a midpoint of $5.37 compared to $4.65 last year, and initial guidance of $5.03, up 15.6% year over year and 6.9% above initial guidance. In addition, management increased transaction margin dollar guidance to $15.45 to $15.55 billion. That's up 5 to 6% year on year growth, up from an initial range of $15.2 to $15.4 billion provided at the start of the year. 9, transaction margin dollars excluding interest on customer balances increased 7% during the quarter to $3.6 billion and remains on pace for 6 to 7% growth for the full year. Most importantly, management reiterated confidence in achieving high single-digit transaction margin dollar growth over the long term. And 10, total active accounts increased 1% year over year to 438 million total active accounts and rose 0.1% compared to Q2, reaching a record high. Monthly active accounts grew 2% to 227 million, supported by strength across both PayPal, consumer accounts, and Venmo. Most importantly, transactions per active account, excluding PSP, increased 5% year over year. Here are the key points from the earnings call highlighted for you. And then as we move on to market, fear and greed still at fear. Active investment managers still a little over their skis. Let's see how this plays out. S&P earnings top 30 weights in the last 60 days revised up 25 basis points or 1/4 of 1% for 2026. With the Russell small caps, that's a lot higher. Top 30 weights revised up. Earnings power is going to be 4.24% greater than they thought 60 days ago. Economic data, we don't have a ton of it. Government still shut down. So to be determined. Earnings growth, as I said, was 9.2%. That is above the 8% estimates. Usually you're 3%. This is only 1.2, 1.3% above estimates. So with that said, let's move on to the questions of the week, the Ask Me Anything questions from our incredible audience, starting with Jim Beam. I love these kind of questions. Complete silly season. Big drops for VFC, Hormel, and Etsy this week. Are you buying more or still above your cost basis? We're massively above our cost basis on Etsy. Our average cost is about $50 a share. That'll settle out in the next few days. Hormel, same story. We're going to cover that one big next week. And VF Corp, hope we can buy a lot more. I hope it gets weaker in the next few days. But we have not done anything on any of those. Patience sitting on our hands and waiting to pounce like an animal when the time presents itself. So if you think I'm just watching paint dry, you're right. And when I get active, you are going to see a flurry of dings on your phone. All the clients sitting there looking, why does he have all that cash sitting there? And why don't I have any margin drawn? You'll find out. David T, congrats on all your success this year. I know you turned down Portillo several times earlier this year. They hit all-time lows this week and it's extremely oversold. I also found out Engage Capital has an 8% stake at a much higher prices, and they are the same activist investor involved at VSC. New board members include previous Chipotle CEO and previous Garden Restaurants Group CEO. Blah, 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 blah. A primary debt instrument not due until February 2028. 2-year solid runway to turn things around. Tell me I'm delusional here. This is David. Let's see. PTLO. I know Mimi loved their hot dogs when she was in Chicago for, I think it was Junior Olympics or ODP or something like that. But let's see. Yeah, I mean, the problem with Portillo's is the revenues seem to be stalling. The margins continue to go down, and the free cash flow is negative. Let's take a look at the balance sheet. And here you just have to see if they live another day. See, this is the main issue. They've got not a lot of cash on the balance sheet. And they have, so the current portion is $6 million. Long-term debt is $240. It's a little levered for my liking, and the return on capital is de minimis. This is a trading vehicle. It's a binary outcome. It can work. It's not catching my. It's not something. The two filters we have are, number one, if JP Morgan was going to finance us to buy the entire company, with the caveat that we had to be 100% of the equity with 100% of our net worth, i.e., if it works, we'd make a 10 or 20 bagger because there's such a small slug of equity. If it fails, we lose everything and go apply for a job as a greeter at Walmart. If we wouldn't do that deal, we won't buy one share. And this is not a slam dunk enough for me to want to buy the whole company. So therefore I won't buy one share. That doesn't mean it's not going to double or triple. It just means there's not enough margin of safety. And the second is, if we were to go in and to the board of directors and tell them we'd like to buy the entire company at the price that it was quoted in the market today, would they have us escorted out by security? And if the answer is no, they would entertain the offer. We won't do it. I think at these levels, they would potentially call security and say, get this schmuck out of here. We're not selling the whole company at $5 a share. But I don't know. But it doesn't pass both filters. So therefore, we wouldn't invest. And again, that doesn't mean it won't work, because it might. Is this something you throw in your PA like a lottery ticket? But I just don't mess around with that. So I think you're probably correct, and we wouldn't be involved. Clorox, we're okay with, Caleb. We've covered that one in recent weeks. Everyone keeps asking me about Fiserv. I have no interest in Fiserv. I hope it works for all of you. Why would you why would you mess around with Fiserv when you could have PayPal? So I'm a pass on Fiserv for the time being. Doesn't mean it won't work. I just don't like it, don't understand it in the way that I understand PayPal, and have the same level of certainty. York Bourgeois. Another one asking about Fiserv. All right, so let's take another look at Fiserv. FISV. Wait. FISV. What was the Fiserv earnings? / full year outlook. Revenue growth, EPS increased, organic revenue. Yeah, I just honestly, when I look at Fiserv, I see where PayPal was 3 years ago. So it could quickly rebound, but I think it's more like you're going to have to deal with 2 or 3 years of pain and a turnaround situation before you start to get recovery, whereas PayPal is already in the recovery stages. This is in the falling knife stage, and I don't think this is going to be a quick bounce back, but if it is, I'm sorry, FI. Yeah, it's the same thing. Yeah, it's not what I want to be involved in, but I don't think you're going to really get hurt at these levels. I just think it's going to take a lot longer than you expect. And you could be on one that's already turning around, or you could be on one that hasn't even started to build a base. Adam Cizzoni. Okay, that's to become a client. That's mid-quarter. We can't do that unless it's over 5. Ryan Burns, thoughts on Mountain Vale Resorts? Buying. Yeah, I've never liked this company. It's just, some things shouldn't be public. I think this is one of them. It's not for me. I don't play these seasonal entertainment games. Ivor Barry. Hormel, we're going to cover in detail next week. Albert Rudell. Expect to receive my golf shirt today, blah, blah, blah. Okay, thanks, Albert. We'll get your picture up on the website. Chris H. Love the show. Knowledge of power. Thank you for making us all superheroes. Finally ordered my gear. Pictures coming as soon as it arrives. Thanks. Resident of Canada. Yeah, I'll be in touch with you on that. Barry Kimbrough, what are your thoughts on beating down insurance sector like Progressive, Allstate, and Prudential? Just send me one, guys. Don't send me 5. That's not beaten down. That's nowhere near beaten down. That's so funny. Zoom out, baby. Welcome to the podcast. But these are not beaten down. So they would not be in our realm of starting to do research on this. That's nowhere near a beatdown. That is a tiny little single tier that is not crying in the soup. We like to buy things when people are crying in the soup. Chris H. Oh, got that. Fantisek Talafra. Thanks for taking my question. Going to repeat all the praise you... Oh, I'm not going to repeat all the praise and thanks you get everywhere. Just want you to know you become my role model over the past 12 months and that I've been following the podcast. That's very, very kind. I'm trying to make you think for yourself. And if I do that, that's key. I don't need to be a role model. I just want to put out a lot of good and let that take care of itself. And I'm glad you're getting value. Teleflex, TFX. All right, let's have a look. I think you might be a little early on this, but let's have a look. So cash flow's going down. Revenues have been flat. Return on invested capital is flat. Margins are flat. Let's see the balance sheet. $1.8 billion. It's a little bit more levered than I'd like to see, but not the end of the world. Income statement. Single-use medical devices. Yeah, this one's worth doing more work. I like your framework. I would like to see some recovery in free cash flow. It's negative right now. I'm not in love with that. I want to see an inflection in that, but it's definitely worth starting to do some work. Elon Patrick. Love your take on Zoom. I'm not against it. I'm just not going to be involved in it. I'll leave it at that. I'm not convinced the moat is strong enough, but they do have some proprietary products that are interesting. I don't think you're going to get hurt. I just don't think you're going to make as much money as you think. Hessam. This is just a dividend play. It's not interesting enough. You're not going to get a double, and you're buying it for this yield, which is 8% yield. There are better uses of capital. Not really for me. Eric Kamis, thank you for the content. Would love to hear your opinion on Comcast. I don't have any interest in that. I can't envision. I think it's probably going to be okay when they break up the parts, but I mean, you got SpaceX. I think that model is at risk, and I'm not smart enough to figure it out, so it just goes in the too hard box, and I pass on it. Roman Chenoweth, silver miners as a leverage play on the debasement trade. I think it's. I think I covered it with David Lynn. No matter how well the metals do, the miners seem to figure out a way to fuck it up. Excuse my language, but they'll work until they don't. They work for 5 minutes and then they AYASF. By the way, the fact that the trade has a name means you're too late for it. So I wouldn't screw around there. Just buy good companies. If the dollar gets debased, you'll just get more of them if your company provides enough value in their respective sector. Like Buffett said, it doesn't matter if we trade in dollars or seashells or coins or bitcoins or whatever. If you provide the best sneakers at the best price at the right time, like Vans, or you provide the best payment services like PayPal, or you provide the best planes like Boeing, you're going to get the most of whatever is on call. And that's something you have control over. You guessing on how far you get debased when you've got record revenues in the treasury at 30 billion a month on the treasury yields, record tax revenues coming in from profits, balanced budget on the way. I'd be careful of that. But we do believe the dollar's going lower over the next few years because it runs in cycles. And we were very minority position on that just a short while ago. Thank you for seeing the impact you've had on my career. I've been listening since 2021. Curious if you ever use third-party research or consulting firms for tailored diligence or market studies on ideas. I guess absolutely not, but it came to mind when you say, quote, do private equity investing in the public markets. I don't know why that would come to mind based on that quote, but let me read further. I've always found it ironic that PE and hedge funds tout their investing edge, yet pay firms like BCG or McKinsey $1 million for a 200-page deck to validate their thesis. I don't know what firms you're working for, but they sound like losers to me. But no, we don't do that. We do our own work, and we have our internal framework that we believe provides a specific edge for the specific style of investing we do, and we don't get distracted by shiny objects or other lanes. We have one narrow lane that we're very good at, and we stay in it, and we mastered it. So we just don't deviate. And then, you get tailwinds when it's really super duper amazingly in style. And then other tailwinds where you just do good work. And even if it's out of style, you can make money because turnarounds are turnarounds. And if all the factors come together, irrespective of what the market's doing, you're going to get your doubles and triples over a few years. And rinse and repeat. So no, we don't pay McKinsey shit. And when we see a CEO come in who had been from them, we're generally we'll leave it there. All right. So Zachary Choinard, big thanks to you and your podcast. I live in Boston, student at Northeastern. Your podcast has taught me so much over the last handful of months after a friend recommended your show. Thank you very much. Whenever I get a notification posted a new video, I drop everything to watch it. That's very kind. Wanted to know your opinions on Progress Software Corporation. Okay, you got it, Zachary. PRGS. Now, as a rule, we tend to stay away from software because the moats can be impaired pretty quickly. This is probably one that's been hit by AI threats. I think it's probably at a level where it's looking interesting, but you have to be damn sure that they cannot be disintermediated either by AI or their moat being breached by a competitor. And that is very hard to be certain about when it comes to software. Revenues have been declining. I'm sorry, that's free cash flow. Revenues are still doing fine. Low multiple. What do they do? AI-powered applications and digital experiences. DevOps, software automation, I mean, if you can understand what they do and you can be damn certain that they have a moat, it's probably a decent buying area, but that's a very hard space to be certain about, which is why Buffett never touched it. But all the other things line up. It's just, you better be damn certain about the moat. Terry Smith, love the show as always. You're my inspiration when I decide what to purchase. Well, inspiration, but then do the perspiration and do the work behind it. Please look at CAG. I think we have, and I think we were good with it in the last few weeks. Yeah, I think this one's going to be okay. This is just all defensives are getting smashed, whether it's Hormel or Diageo or Baxter, and they'll get smashed until Mag 7 goes down, and then people won't be able to get enough defenses. We saw a few flickers of that earlier in the month when there was volatility. I think this one's going to be okay. Next. ArcelorMittal steel play. I'm not a big fan of these, to be honest with you. It's a commodity business. I mean, it's changing by the day based on Trump's tariff. Looks like it's starting to recover. Cash flow starting to recover. I mean, you know, the time to buy it was when it was 6. So now it's 40. You're interested because it's showing a breakout on the chart. You're probably right. It's a trade. That's, you know, it's a cyclical trade and it's already 5x. So yeah, if you want to chase it up here, you can probably squeeze some more out of it, but it's not for me. Brian McLean. Okay. Thank you for the nice note, Brian. Anna M. FMC. We agree. Yeah, FMC we get every week. Every week we say we're fine with that one. IBEC. Can't express my gratitude in words. Thank you, IBEC. That's very kind. What do you think about Chipotle? Personally, a fan of the product. Stock is down 40%. Thought it might be a good buy amid the easing cycle and decreasing beef prices. Yeah, they got hit after hours as well. I think it were down 13%. CEO was a little bit concerned about people in their 20s earning less than 100,000, which was his target market. And he doesn't think they're going to competitors. He thinks they're going home. Eating at home. Yeah, he lives in town. I wouldn't bet against this. And I've met him and spoken to him. I mean, not about the company, but I like the idea. I like the theme. I think you're a hair early, and I think it's going to be okay in the long term. So for me, I would probably just wait a little bit on this one, in my humble opinion. Kostas, greeting from Greece. Kostas Monogius. Been listening for almost 2 years. Thank you. Great value and my appreciation for all your effort on that. Can you take a look at INMD? Okay. INMD. It's healthcare. Man, this thing got smoked. All right, let's see. It's medical devices. This is the space I want to start to get more and more exposure. Yeah, free cash flow is getting crushed too, and revenues. So you got to see some signs of a turnaround. Free cash flow last quarter started to look better. What about revenues? Yeah. What about balance sheet? Looks pretty good. Looks good. Yeah, I think you just really want to study their products and understand if they have an actual moat or a potential breach to the moat. Medical products based on radio frequency. So just understand and see if it's durable, but leaving that aside, let's see. Probably not going to get too hurt with this one. It's absolutely left for dead. Also study management, see what they've done in the past, if they've done a good job for shareholders or not. But I think you're on the right track there. All right, here is from Eduardo Figueira. He's from Portugal. My Portuguese brethren here has got a podcast, wants me to get on his podcast. I think it's brand new. I'll do your 25th episode. So you got to make it 25 weeks, build up your audience a little bit, and I'll go on. Let's see. Nikolai Johnson. If you had to buy an index or several for the next 5 years, what would you buy? I'd probably buy small caps. A few months back, you had me second guess a position in Sprouts Farmers Market and helped me sidestep a big decline. Thank you. Just bought and read the book Nature of Risk. Sentiment cycle. Even if you don't like the grocery business, can you discuss what you'd look for in a stock like this? I wouldn't get in the grocery business, but certainly when a low quality business has gone parabolic. I mean, this thing hasn't even begun getting smashed yet. So he was asking somewhere up here, and I told him, stay the hell away, and it hasn't even begun. This thing is done. This is in distribution. All the institutional people are getting smoked. The retails have gotten their accounts liquidated, and it hasn't even begun. Now you got all the dip buyers that are going to get really smoked, and you can just go over to the mammoth cycle that we cover many times, and here is where you are. With Sprouts Farmers Market, you are right here in subtle warning, overt warning, and you're nowhere even near panic. Then a year from now, you'll be in discouragement. And maybe if the business lives, you'll get to start to get back to anxiety, aversion, denial, and then returning confidence. But you're 3 years off from that. That one hasn't even begun. I think that is. Oh, thoughts about Boston Beer Company? No, I have no interest in that. I know the guy came back, so that it has a chance, but it's not for me. So with that said, we'll be back next week, same time, for a different place, New York City. In the meantime, make it a great one. Bye for now.